If you think Canada's housing crisis is bad now, you haven't seen what's coming. Over the next 18 months, hundreds of thousands of homeowners will see their mortgage payments jump by 30 to 60%, and many won't be able to afford them. This isn't a theory. It's baked into the system, and the banks already know it. You've probably heard about rising interest rates, but what most Canadians don't realize is how many people are trapped in time bomb mortgages, the kind that quietly build up debt until renewal day hits like a hammer. Here's what's happening. When rates shot up from record lows in 2022 to over 5% by 2025, most variable rate borrowers saw their monthly payments frozen by banks. Sounds good, right? Except the unpaid interest was quietly being added to their mortgage balance. It's called negative amortization, and it means the longer rates stay high, the more your debt grows. Now those mortgages are hitting renewal. Banks like RBC, TD, and CIBC have confirmed that tens of billions of dollars in loans will reset between 2025 and 2026 at rates double what people signed up for. A family who locked in at 1.8% in 2020 is now facing renewals at 5.5% or higher. That's a jump from $2,000 a month to over $3,200 on a typical home. And here's the scary part. Many borrowers don't qualify to refinance because of the mortgage stress test, which requires proving you can afford payments at even higher rates. So people are getting stuck with shorter terms and massive monthly costs they can't sustain. When enough people can't renew, they start selling. That's why listings have quietly surged in cities like Toronto, Calgary, and Vancouver since spring 2025. But buyers are drying up because affordability has collapsed. The average household would now need over $180,000 in annual income to buy an average home in Toronto. In Vancouver, it's closer to $230,000. And it's not just first-time buyers. Investors are bailing too. Many who bought pre-construction condos during the boom are walking away from their deposits because they can't close at today's rates. Add it all up, and we're staring at a slow-motion correction that could reshape the housing market for a decade. It's not just over-leveraged investors. Middle-class families who bought between 2020 and 2022, when rates were at rock bottom, are in the danger zone. Many took on variable or short-term fixed mortgages, assuming rates would stay low. They're now facing renewals that eat half their income. Even those who can hang on will feel the squeeze, cutting spending, downsizing, or dipping into savings. That ripple will hit the entire economy, from construction to retail to services. If you're renewing soon, act now. Don't wait for the bank's letter. Talk to a mortgage broker early. Explore blending your rate, extending your amortization, or making lump sum payments before renewal. If you're on a variable rate, check if negative amortization is inflating your balance. And if you're buying, remember, affordability matters more than FOMO. Canada's mortgage crisis isn't coming. It's already here, just hidden behind payment deferrals and short-term renewals. The next year will separate those who plan ahead from those caught off guard. If you found this helpful, subscribe and share this video. Because when it comes to protecting your home, knowledge really is your best defense.